Here's another late development, and this news keeps coming in as we're talking here.
This week we'll be talking about the book. For those of us that read it, I think this was a really great chapter. One of the biggest things, the most popular things everyone's talking about is options. How to make money on options. Everyone's talking about it. Everyone's trying to learn it. But one of the things that we are trying to do is really understand how it works. I feel like a lot of people don't just jump into it and they're actually trying to learn the way that we are learning and trying to make sure that we understand what we're doing as we're learning it and by doing it. So I'd love to see what y'all thought about this book. I thought this chapter was a really dope chapter. I feel like I learned a lot more about the stuff I didn't know about options. There's all kinds of stuff in there. Anyone go ahead and talk first, or I can kind of jump through and walk through what was talked about.
Well, for sure, chapter 2 is going to be something that calculated risk and all of that stuff, but I really enjoyed that they started digging into the options play a little bit more, understanding not only what the numbers mean in the Greek and revisiting the Greek, which is super important, but understanding what your takeaways are in the option field. I think a lot of people go into options not understanding that it is a high risk, high reward, but it's like a glass cannon. It's a one-shot kill. You make your shot or you miss it. And also understanding what volatility and volume and how they're not one and the same. One of them they're inversely proportionate in a lot of situations. So I was really thrilled to reread on that.
Facts. I think they did a great job of breaking down the things that make a good strategy and options. Because first they kind of started off with what it is, what is an option, what does it really mean to say, okay, I'm trading options, and what are the different types of options. And now they went into that, what you said, such as volatility, volume, what are the things that move these options, what are the things that you got to really understand and know. So that was something that was really dope. And we kind of walk through what talked about. So first they talked about options, what an option is, that being the derivative security attached to stocks, where you can trade, you can kind of get leverage, but not the obligation to sell or buy a stock at a certain price, 100 shares of that. I think really explain that well in the book. They say, okay, this is the literal definition. This is what that definition means. And then they also say, okay, what does that really mean? They say, okay, options trading, all you need to worry about is that it's low capital. You put a little bit of money. It's very risky, so that's high risk, but then the reward is really high. That's why a lot of people are really attracted to it for the high reward. And the fact that you don't put enough money into it, much money into it.
But there's the trap in itself, because the exit strategy, and they spent a little bit of time on this, but I would have really appreciated if they gone into depth a little bit more about exit strategies. It's so important for you to know how to get out of an option play, because at the end of the day, options aren't the same for everybody. Meaning you could get in on the same option at the same strike price at the same moment and set it for the same expiration date, but because of when we're looking at the market, it's going to look good for me at 20% profit. Meanwhile, at you could take a negative 5% profit and hang in there. Nice. And be like, I'm not going to fall out because I got 3 weeks on this option. So really understanding decay, understanding theta, and just being able to have a firm exit strategy.
I feel like this was kind of the introduction chapter to that, to talking about the strategies and places where you can enter and exit. I think in the next chapter they go into the deep analysis of how do you go in the different strategies. So I think that is the next chapter. So that's a good point. And we can read that for the next segment. So that'll be 2 weeks from now when we review it. So over the next 2 weeks, we can really learn the strategies in that, and entries and how you exit and things like that. But bet. Let's see, what else did they talk about in the book? They did talk about the difference between a call and a put. That kind of makes sense to everybody. Anyone that don't know the difference, calls and puts.
Go over it real quick.
Facts. For calls, for those who don't know, a call is basically one type of options contract. So with options, you're not buying the stock outright. You're buying a contract that gives you the right to buy 100 shares at a certain price. And with that contract, you can either say you want it to go up or you want it to go down. So it's kind of a different type of contract. So are you buying a call contract or a call option, which means you have the right to buy the stock at the price that you agree on, which is the strike price, and we can talk more about that, or a put option. So a put option basically being the opposite. You have a contract that gives you the right to sell them at a certain price. So you can go and say, hey, I want to sell 100 shares of this to this person if it hits this point by this date of expiration. So it's kind of like a written contract. It says, wait, are you going up or down? Because stocks, they can only go two ways, up or down, or they just stay where they're at, sideways. So the contract reflects that you can either get one that goes up or goes down. And
I have a question.
Yeah.
So which is the better one that you would choose? Or
So
is there not one? It's just whichever one.
that's a great question, actually. That's actually a very great question. And the answer would be, it depends on the situation and pretty much your style of trading, if that makes sense. But in the situation for me, my personal opinion, I'm someone that understands that calls, I guess, to explain context, with calls, you have limited loss and unlimited profit. But with puts, you have unlimited loss and limited profit. So if you're someone that is still learning and being a beginner, it makes more sense for you to focus on calls rather than puts, because puts really are very risky, if that makes sense. Because you're kind of borrowing, because typically you won't have 100 shares of the stock itself, but you're writing a contract that says, hey, you're going to sell it despite you not having it. So that's a little bit riskier. If, okay, you now actually have to go buy it and then sell it to the person that signed the contract with you. So for beginners, I personally believe calls are better and safer because you have unlimited profits. And this book kind of explains some of that, where with the call, you want the stock to go up. And if it can go up to any price, but with a put, like you're betting that it's gonna go down. But if the price goes all the way up to infinity, that means you gotta pay for that now. And it's like, that's infinite loss. But instead, you only make a certain amount because you only put enough money. The premium, if it goes to zero, that's as much as you can make, if that makes sense.
That does. Perfect. So I guess I'm a call person.
Basically,
Well,
I'm personally a call person. I think other people talk about it too.
Yeah, I'll add this 2 cents to it. With the call and the puts, the call and the puts are a reflection of the market. And if we're using the market from 2018 that increased 12%, any given day, the market's going to go up. So you never want to put yourself to be betting against house money. Always put yourself on the flow and in the favor of it. Now, if Uber CEO came out and dropped the N-bomb, then obviously put a put on Uber because their stocks are going to go down. Think of puts as if something's going to go down, you want to put. If you think something's going up, you want to call.
Facts.
Thank you, brother.
Bet. Something else they go over. So that pretty much when they talk a little bit about that in the calls and put section. They also did a great job and talk about the different things that make this, that make up the specifics of a contract, such as the strike price, the expiration date, and things that you have to agree to when you get an option. And that's something that makes it a lot more complicated than stocks. If one of y'all could talk about that, I gotta go run and grab my charger real quick. I think Heero, Hamid, I think you know more about like strike prices and things like that, and like what the book kind of talked about too.
Hamid, earn your credits, son.
I'll be right back.
So before I did some reading and things like that, and trying to understand the Greeks. And I wish I would have done that beforehand, like before I first got started, because most of the time you learn about basic options, they just teach you what options are. They don't teach you what all those things are. And if you've taken like physics, like basic level physics, and a little about calculus, the Greeks basically kind of work like that a little bit. It's just rates of change. Mm-hmm. I don't know if you want me to like break down my quick knowledge of each one or.
No, I feel like that's going to be Steve style for like chapter 3. So okay. I would say go with the overarching topic. So like
the big one is delta. Delta is the one that tells you how much the option is going to change, how much the option price will change by when the stock goes up $1. Because you have sometimes when you're looking at it, you think it's not proportional all the time. So delta helps you understand that. And gamma is just the rate of change of delta. So like I said, the physics comparison, like delta is speed and gamma is acceleration. That's the way I think about it. How the delta changes. And then theta is just time decay. How much as you get closer to your expiration point.
Theta is death.
As you get closer to the expiration point, like how much it's gonna change, which is something to really know, because you're always like, I think it's gonna hit 450. I got a week left. What should I do? You know, and theta is really gonna be useful for that.
And
I
as
did
far
not know
as
that was the thing. Like I've always wondered, like, how do I know how much a stock is going to like decay over time? But I didn't know that was a thing. They give you a number that says, "Hey, this is the exact number that's going to."
and it's kind of
That's
baffling,
crazy.
and that's why then it becomes baffling when people do options and lose money, because it's like they tell you everything bad that could happen, and it's like it's a calculated risk, but to a fault. So it's about how much risk you're willing to put in.
Facts.
And a general rule is, if you're not willing to spend a pretty penny, like if I don't think, like, if it's a $30 option, I don't think going into that option spending less than $100 is safe. You got to be willing to spend $250 for a $30 option for you to really say that you're going to be in a safe space. Like, then you get into in the money. Is your strike price in or out of the money? Being in the money is something you want to do all the time as a call, but at put, you want to be out of the money. You want to be as far as out of the money as possible. So understanding those concepts and why being in the money is better, because you're betting that even if you have a bad day, you're not going to have the worst day in history.
No, that's a great point. I feel like the thing is that most people that start, they don't really know like what that is, because when you open up,
Learn the Greek
like,
first.
it's all numbers. It's all numbers. You just see all this theta, beta, alpha. Like it don't make sense. You just see a number and it don't make sense. But once you learn it, and it's something that makes this book really great, because they break down what each of those things mean. Those Greeks, those numbers and things like that are on your screen, are available. So if you don't look at it, you should know it. But it's like, it's so complicated when you first look at it. But this book, I feel like this book explained a lot of stuff, and it kind of clicked for me, if that makes sense.
No, for sure. Learn the Greek before you buy an option. If you can't rattle off theta, delta, gamma, like just off top and recognize them, don't do it.
Facts. But what do y'all think about, so there's another thing that the book mentioned was that these numbers do change each day. So like one day the theta will be this, and the next day the theta will be that. Like, what do y'all think about that?
And that's the second part, volatility. They change based on volatility, and volatility is based on volume. So if you're dealing with a stock that has less than a million a million trades going on with it, there's not a lot of volume in there. There's not a lot of people trading that. So one person could come in here and buy 50% of it and change the market for you completely. And you tend to see this happen with smaller stocks. So if the stock is under $100, some dude with $1 million could walk in there and be like, you know what? I feel like owning this today. And he buys everything. And if he chooses to sell when you're trying to get your contract off, you're just out of luck. You're going to lose your money. It could go to $100 extra. But the moment, if you don't sell between the time he decides to buy and let it back out into the market, you're SOL. So volatility and volume then become like the second demanding factor. You need to make sure that you can't buy a penny option. Everybody's thinking like you. Don't be basic when you come to your option plays. Don't be basic.
And that's Vega. The Greek for that is Vega. That's what measures.
Exactly.
Facts. That's actually a great point. I feel like a lot of people don't learn enough about this, and it's great that like we're able to like start learning that, so we can really make informed trades on, okay, we know that this is what we're getting into. I think another thing that they talked about in this chapter was about the probability of things. Like with these numbers, you got to really understand like what is the probability of this happening, because a lot of people just speculators, I think this is gonna happen, I'm gonna put my money into it, but they don't really think about, okay, what is the actual probability, and look at, okay, if this is a high chance that this is a good time. Nuffy is asking, so I need to learn the Greek letters first. I think it's a great thing to, like, you need to know. The four main ones, or I think the only ones that they talk about are it's the theta, the vega, which other one were the other two again? I just forgot the
Delta
theta,
and gamma.
Delta and gamma. And the book, definitely check out chapter 2. The book kind of explains each of them quickly. Hamid also talked about it just before too. I'm not sure if you caught that.
Yeah, and also, it's not something that's like incredibly difficult to learn. I know it sounds like it is, but once you see it and see how it's applied, you'll pick it up right away. You can find it on like Google and things like that. It's really easy once you understand what it is. It's a quick reference. It shouldn't take long to, yeah.
Yeah. Yeah, and
Awesome.
it's
Thank
a
you,
huge
guys.
game changer. It's a huge game changer. I don't really understand how Vega works really, and I think it's
It's just the volatility. It's just the change of it's the volume and volatility of the market of that.
I still gotta learn and practice more like using that numbers. I think the only ones I've kind of looked at are theta because I want to know, okay, how much is going to decay? Should I get out now if it's a looting trade versus sooner or later? And it's interesting how you can like really use these numbers to like dictate what the chances are of your trade, so you can really know, okay, this is something you should not, because it gives you signals that says, yo, the theta is too high, or the way it's moving, or the way that it's not worth an entry. Because some people say, oh, this is a great company and it's going to move up, but if the numbers are not going to move up as much as you think it is, it's like it don't make sense to put it and risk that much. So I think that's a great point. Another thing that they also talk about is the options pricing. So everyone wonders, okay, an option, you buy it, you sell it like everything else, like a stock. It's easy, but it's a lot more complicated, where it's not just you buying ownership of the stock, but essentially you're kind of breaking into three. You're buying into three things that make up that price, that number. So when you see a price of a contract or an option, they'll say, okay, for the options, for this strike price, you have to do 50 cents per share, but then you multiply that by 100, you get the actual price of the contract. So that would be times 100. So if it says 50 cents per share for this contract, that means the premium of that option, so how much you got to pay to buy that option, is 100 times that. So if it's 50 cents, 100 times that means the contract is worth $50. That's the price of it. But what makes that price up, the book talks about it, is intrinsic value, extrinsic value, and time value. So what that means is, with intrinsic value, that is the actual money that the option is worth. So with the option saying, hey, you can buy 100 shares of Microsoft at $200 and it's $250 today, that means you are guaranteed to make $50, that $50 difference times the amount of shares you have, which is 100 for each contract. So that means the intrinsic value of that option is that money or profit that is guaranteed. So if I say, hey, I'm buying an options call on Apple to reach 200 by the end of this week, and it's at 250, I'm guaranteed $50 profit. That's 250 minus 200 on the spot if I bought and exercised that option. So that's the intrinsic value that makes the price. Typically, stuff that are out of the money don't have any intrinsic value because it hasn't hit the price yet. Everyone understand what in the money and out the money is?
Yeah, relative to a call.
So out the money, if a stock option is in the money, it will have some intrinsic value. That means there's some profit that's guaranteed, and that will be kind of included in the price. But for out the money, you haven't reached that criteria yet. So basically, there is no intrinsic value because there's no profit on it. If anything, it will be a loss. So the intrinsic value is zero. Then there's extrinsic value. So this is the kind of the flip side of intrinsic value. It's basically when you say, okay, what do people hope or think is going to be worth? So if I think, okay, my option doesn't expire to next year, but the stock is at 250, but my strike is 200. That means in a year's time, I can make this amount of money within that. That's based heavily on the volatility. So if it's very volatile, like for Tesla, moves about $60 each day. You can go from 400 to 500 by the end of the day. That is about huge volatility. It moves a lot. So that means there's more chances of you making money and it going up. So that adds value, which is called extrinsic value. It's not actual guaranteed profit, but it's kind of the hype that people believe. So if I say, oh, this could make me 200 one day, of course I'm going to sell it to you for 200 now, instead of giving it for the actual price it is worth right now. And that's kind of the extrinsic value. Then they also talk about the time value. So depending on when it expires, how much money can you make, if that makes sense. So I think this kind of explained all of that in a good nutshell. Anything that stood out in this chapter for you guys, or any questions this kind of sparked? Jesse?
No, the biggest takeaway for me in this chapter were the Greeks. I already knew
Facts.
delta, and I have like a rule where if it's not 0.8 or higher, don't enter it, because the price of the option isn't correlated strongly enough with price of the underlying stock.
Oh, man,
But
you're
it was
so
good to
sure
learn
nothing
about
on that
the other
0.6
Greeks.
life.
Big
You
facts.
said 0.6.
Yeah, go for it, bro.
Facts. But yeah, that pretty much summarizes that book club segment. I think everyone should be able to go check that chapter out if you haven't. We'll probably go over the chapter 3 next time in 2 weeks or in 2 episodes from now. But I think it's really great. This is probably one of the best like summaries I've seen on options trading. A lot of people have questions about this. Options are like things that they need to look at, but they don't really actually check. Say, okay, what are the things they need to know? And this is basically all the basics that you need to know before you go like trading. So you understand a good chunk of this before you trade. But yeah, that is the book club segment of this week.